Hello, friends. Today we'll be looking at quantum long-term equity portfolio construction process, and how do we approach portfolio construction? And our submission to you is the way we approach portfolio construction is we are not cognizant, we are not really looking at what the index is doing, but we would look at each of the company in its own merit, and that would possibly occupy a large chunks of our portfolio. So let's go through what are the key ingredients or that goes behind the portfolio construction. To start off with, we have a very large market in India. There are close to about upwards of 6,000 companies which are trading in the various indices. The liquidity criteria, which is very important for us, which we define as upwards of $1 million or more. There are about 1,090 companies in India, and 827 of them trade about $2 million. So that's a pretty large and liquid market if you were to look at it. So our submission to you is that this number is a bit elevated in the current juncture where the market has seen fairly good growth post-COVID. But if you were to look at this number, let's say, pre-COVID, this number used to hover around 300 to 400 companies. So the liquidity in the market has considerably improved in the current juncture. Some of it is, the deepening of market, but some of it also could be, there've been more participation from the retail bucket, which could be transitory in some sense. So what are the key macro assumptions that go behind, the stock selection? So we are largely bottom up in terms of our portfolio construction, stock selection, but we require few inputs in terms of the key macro drivers on which the companies would, perform. So we use probably four macro themes. One of them is what would be the long-term GDP growth? The long-term real GDP growth from India has hovered around 6 to 6.5 for a very long period of time. So we do not think that will change. So this feeds into what we think, let's say, what a cement company could do in terms of their volume growth. What we have seen is the cement volume growth could be in the vicinity of 1.2 to 1.5x real GDP growth. So if a cement analyst is modeling his volume number, he would probably use this as a base case assumption for forecasting the volumes and adjust based on the regional divergences that he sees or he or she sees. Some markets could be going faster, some could be growing less. Long-term inflation is 5 to 5.5. The current number is a bit lower. So this is what we would use in terms of inflation to decide possibly what could be the real wage increase, the wage increase that we see in various companies and so on and so forth. The 10-year bond yield has hovered around 7 to 7.5 for a very long period of time. In the current rate cut environment, it's close to 6.58. Potentially, it can go down even further in the near term. And the FX assumption is plus minus 2% in terms of currency depreciation. Generally, India has depreciated currency versus the, let's say USD over a period of time. This would feed into what we think about how our revenue assumptions would move for, let's say, a pharma company, IT services, which are more export oriented, geared towards US. So broadly, apart from these four assumptions, we do not really think about macros a great deal in terms of stock selection. So what is the process? So if you were to look at it, our long-term objective is to look at to expect steady compounding from our portfolio companies, and it is very critical for us to look on each company, how it behaves in a certain environment, especially the structure that we operate in India. So a business is very important, how it works within the industry. If you were to think about a company, if you were to look at, the depth of management, that's very important. You know, if you were to think about how the company has done in the past few years. So these are all certain criteria that we would think about before selecting a stock. And we have possibly a fairly large analyst team, which would typically cover one sector or two sector at the most, and they would be looking at each company in great detail. And one of the pivotal things that they do is be on the ground as far as possible, possibly, looking at meeting companies, doing channel checks, trying to understand each company and the environment at which it operates in. So that's very important in terms of, understanding the company, understanding the real business. Then what follows, we would typically attach these companies once we have determined the intrinsic value, um, a multiple. This multiple could range from price to earnings, price to book, EV to EBITDA, DCF valuation in certain cases, etc. So here again, our whole endeavor is we are trying to figure out what would be the normalized earnings for the a particular company, and if the company were to give out those normalized earnings, what should be the multiple that we would attach in terms of valuations. So a combination of these is getting to that intrinsic value, and it is our endeavor in each of our buy decisions to buy the company at least at about 25% discount to that said intrinsic value. And we would sell out a position as the company reaches the intrinsic value, or it surpasses the intrinsic value in our portfolio. Here is how the waterfall works in terms of stock selection. There are about 1,090 companies which meets our liquidity criteria. We don't think 1,090 companies is the true reflection of the liquidity. Possibly this number could be much lower. Given the euphoria that we've had in the recent past, this number is a bit elevated. But broadly, 1,000 number, if you were to weed out the governance, governance reasons, for liquidity reasons, for ownership, etc., you're left with around 200, 300 companies broadly to track, and out of which we have an active coverage of about 200 stocks. And these stocks are covered by analysts, and the analysts, it's imperative for them to meet the management, in their offices, and to understand um, as much as possible about the company. And typically, we have, as part of a research process, weekly discussions around the stock ideas, and wherein we are trying to essentially poke holes in each of the other analyst arguments with respect to stocks, and to understand how watertight the argument is in terms of investment thesis. And once these stocks are approved with a buy and sell, when the stock comes near our buy and sell, it's a portfolio management responsibility to possibly see if they could come to a if at what price or what position size which they be part of our portfolio. So typically, out of these 200 stocks in our coverage, we typically tend to have around 25 to 40 stocks. The 40 number is usually in crisis times like GFC crisis or the COVID crisis, where the number of stocks increases because there are enough and more opportunities. But by and large, it's around, the current number is close to 29 stocks. It really does not matter to us whether the stock is in the index. In that sense, we are index agnostics. And if you were to look at our portfolio currently, you think about FMCGS sector, we have not had any allocation to that sector for several years, primarily due to valuation, and that would be a large portion of the index. If you look at, some of the real estate sector, or, which has again a significant portion in the index, we would have absolutely nil allocation to it, again, because it does not fit our corporate governance filter. So we don't mind being quite away from the index, and in a sense, we are index agnostic. So it does not really matter to us whether the stock is in the index or not in the index. What we want is it to be liquid, which we define as 1 million or more. So if the stock is liquid, it does not matter if it's part of the index. What matters to us, if it is below our buy price. If it is below our buy price, again, it does not matter which sector it belongs to. Theoretically, we could be large portion in the sector if it offers significant value. And if it is within our buy limit, the portfolio team would act, and we would possibly be deciding the position sizing. Now, the position sizing at cost could be, 2%, 4%, 6%. Now, what matters is where that number would be is the quality of earnings, how the management pedigree across cycles, the stability of earnings, possibly the upside potential in the stock that we see. So some of these factors decide really whether a position in our portfolio should be 2, 4, or 6. 6 is the max that we could go to. At market, we let it run until 10% also. So Given this portfolio construct, and we are index agnostic and more valuation cognizant, what you see in our portfolio is the cash across the portfolio is pretty divergent. It is all over the place, and it is purely a reflection of what we see our portfolio companies do. So if we are not finding enough opportunity in our portfolio, that is, a lot of stocks are hitting a sell limit, especially in a euphoric time, we would be mostly selling out of those positions, and the cash would be building up in the portfolio. But if you see the times like GFC or COVID or any other crisis period where the valuations are substantially cheap, our allocation could be as high as 99, 98% with virtually no cash. So it is primarily driven by what we see in terms of valuation and the opportunity subset for us. So, given that as a important criteria, we also want to lay aside the earnings, what the role of earnings in our portfolio. So the earnings are also very critical in our portfolio. So typically, as I said, if you were to determine the intrinsic value, we typically look at least a 2-year horizon to decide a buy and sell. And in that time frame, the earnings that the company is supposed to, it could be a combination of valuation, or it could be a combination of earnings. uh, a combination of these two would drive the intrinsic value. And what we have seen is the current earnings trend, especially post-COVID, is you know, fairly strong. So in a sense, like what you've seen is that the blue chart that you see is the Sensex price, how the index has moved, and the other line charts that you see is how the EPS have grown. So broadly, in the current environment, what we have seen is more consensus upgrades. That's possibly because of the resilient earnings growth that we are seeing in the economy, which could be, correcting in FY as we enter FY26. But broadly, the current rally that we see, at least in the last 3-4 years, is broadly driven by earnings, as opposed to what we saw in 2016, 2019, where the earnings were getting cut, despite the markets doing well. So broadly, three criteria, which is very important, how we construct a portfolio. We are absolutely index agnostic. It doesn't matter to us whether the stock is in the index or not. We are valuations conscious. We are liquidity focused, and of course, governance focused in terms of constructing the portfolio. Thank you for your patient listening. May you have a great time. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.